Good morning and welcome to today's webcast, Healthcare Merger and Acquisition Market Update. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and with that, I will turn it over to Chris to get us started.
Thank you, Emily, and it's a pleasure to be with everyone today. We have a very robust agenda, and I've been looking forward to this discussion for quite some time. We've outlined in our agenda to cover current market trends, the alignment between buyer and sellers, particularly when you're considering PE investment, VC investment, health system investment, or other buyers. Preparing for transactions, covering due diligence, financial records, valuations, etc., how transactions are different between PE acquisitions versus health system buyers, closing deals in the COVID era, how to handle pandemic relief funds when you're structuring a transaction, and then post-transaction feedback from sellers. And so we're going to be covering all of these areas. And before we get into them, I want to introduce my fellow presenters here today. First, Paul Kacik. Paul is a managing director with the investment banking group at Moss Adams and leads the team's efforts in the healthcare sector. He's been a healthcare investment banker for over 20 years and has acted in a lead advisory role on numerous domestic and cross-border healthcare M&A transactions within the healthcare services, including physician practices, behavioral health hospitals, managed care, and pharmaceutical services. Prior to joining Moss Adams, Paul was a managing director and head of healthcare investment banking at Hospice Bank. He also earlier served in similar roles at Duff & Phelps, D.A. Davidson and Company, and Wells Fargo Securities. We also have Ryan Petrucelli. Ryan is a director in the Transaction Advisory Services Group and is based in our Moss Adams San Francisco office. Over the past several years, he's worked on over 100 due diligence projects and has experience working with buyers and sellers across the healthcare industry. My name is Chris Bell. I'm a Moss Adams partner, and I'm the national practice leader for all services provided to physicians and medical group practices. Prior to joining Moss Adams, I managed a medical group practice. And so this is a topic that's near and dear to my heart. With that, we're going to turn the time over to Paul to cover current market trends.
Well, thanks, Chris. Let me just start by talking about the environment we were in within the healthcare M&A markets just prior to COVID-19. The healthcare M&A markets were very active. They've been extremely active since going back to 2009, 2010, just after the previous recession hit. Private equity and strategic buyers were paying, very, very lofty valuation multiples for companies. It was not uncommon to see multiples in the mid-teens for medical provider businesses generating anything over 10 million of EBITDA. That all stopped with COVID-19. Deals were put on hold. Private equity buyers focused on their existing portfolio companies. Strategic buyers focused on keeping their own businesses safe and securing PPP loans, and just generally making sure their own ships were running smoothly, as opposed to focusing outward on M&A deals. The good news is that we are starting to see signs that deal flow is coming back. Sale processes that were put on hold are for the most part back on the market. Time will tell whether the valuations will remain at previous record levels. My guess is they probably won't. But we still have some of the same dynamics that drove up valuations in past years that are happening right now, i.e., record levels of uninvested private equity capital, significant competition for deals, and so on and so forth. However, two elements that could affect deals and the number of deals and valuations are a general tightening of bank lending multiples. Banks have gotten much more tight with their money, and that ultimately has an effect on valuations. And obviously, in addition to that, earnings performance of healthcare companies in light of facing continued COVID-19 issues. So if we look at this first slide here, this slide really covers the public markets in healthcare. It serves as somewhat of a guide for private M&A markets. What happens in the public markets ultimately has a knockoff effect on the private healthcare M&A markets. When the public markets are strong, generally that leads to more M&A activity and at higher valuations. Valuation multiples for the healthcare sector have trended upwards throughout the start of the year before a sharp decline in March 2020 due to COVID-19. The healthcare segment has begun to recover from a low in March with multiples near year-end 2019. So that's been a positive in the public markets. If we look at this next slide here, this slide really covers how Wall Street analysts are viewing things. This chart is a compilation of the leading Wall Street equity research analysts focused on healthcare and their prediction for revenue growth over the next 12 months. What it shows us is that post-acute care, rehab businesses, as well as home care, home health, and hospice, at least in the eyes of Wall Street analysts, are expected to see significant revenue growth over the next 12 months. And what they're estimating is that buyers are looking to capture increased revenue growth in these sectors and therefore are driving higher valuation multiples for these subsectors. Again, looking at the stock performance over the last several years, home care and hospice stocks continue to be the top performing subsectors within the healthcare by measure of price performance over the prior 3-year period. Senior living, assisted living, senior housing companies has been the second highest performing subsector and experienced the smallest decline in price from February 2020 peak due to COVID-19. So let's kind of move on to M&A volume trends. If we look back through 2010 to today, actually volume trends have been fairly consistent, averaging generally between 400 and 600 deals per year, depending on how you look at and what you constitute as a deal within healthcare. But generally, they've been fairly consistent. If you look at 2018 and 2019, there was actually a drop in the number of deals between those years compared to previous years. However, it's a little bit misleading. 2018 and 2019 were both actually record years in terms of valuation. So in spite of the fact that fewer deals were being done in those years, valuations were trading at all-time highs. Again, if we compare year-to-date through June of 2019 to year-to-date through June of 2020, we actually see there's just been a slight dip. Most of that dip has come within the last quarter, second quarter of 2020, obviously in relation to COVID-19. But overall, we're still seeing activity within the sectors.
Hey, Paul, I understand this is how the reporting of these transactions comes out, but physicians and medical groups would fall under the healthcare services component to these categories. Is that correct?
That's correct. Obviously, different platforms would segment. For the most part, we use Capital IQ database for this. Capital IQ segments physician groups into what they call healthcare services, as well as other elements of healthcare providers. So if we take a look at valuations, these slides are a bit busy, but hospitals, if we look at acute care hospitals, on average in today's market, hospitals are trading at 8.6 times EBITDA, trailing 12 months EBITDA. Post-acute care companies are trading much higher at about 15.3 times trailing 12 months EBITDA. Moving forward, if we take a look at senior assisted living, those businesses are trading at 12 times EBITDA, and home care and hospice are trading at 17 times. So quite a hefty multiple, even in today's market, and we're still facing COVID-19 issues with a lot of companies. The one sector that we didn't capture in here, we just didn't have the data at the time, was actually the healthcare IT sector. Healthcare IT is a very hot sector right now. There are a few publicly traded companies, but most of the real healthcare IT businesses or tech-enabled services within healthcare are privately held, so they won't show up on these metrics. But they're still doing very well, obviously, right now. This gives you a few more valuation metrics. Healthcare services, which is where medical groups fall within, on average, the public markets are trading at 11.3 times. And then finally, healthcare distributors are trading at a lower multiple at 9.6 times. So what does that all mean for healthcare M&A activity? Well, we're actually starting to see that healthcare M&A activity is coming back. As I mentioned earlier, a lot of the deals that were put on hold prior to COVID-19 are now starting to come back, and that's being reflected in some of the deals, the closed deals that we're seeing right now. In April, just as an example, Medicis hospice division acquired AseraCare Hospice, which is a national provider of hospice services. That was a $235 million deal. Also in April, TPG Capital, which is a large private equity group, acquired a behavioral health company called LifeStance Health. That's an outpatient behavioral health services business. That company was acquired for $1.2 billion. Also, again, in April, we saw Webster Equity, which is a well-known healthcare private equity group, close on a platform called Gastro One, which was a gastroenterology business. And then more recently, in June, late June of this year, Lee Equity, another healthcare-focused private equity group, closed on a platform in the urology space called Solaris. So we're starting to see more and more activity, and private equity groups are starting to get more comfortable in closing deals. Currently in market, one of the high-profile deals that's currently in market that we're watching to see what happens with is Cancer Treatment Centers of America. They've been rumored to be out in late stages of closing a deal. And then another company in the pharma services space, a company called ProPharma Group, which is a pharmaceutical services business, they had put their transaction on hold just prior to COVID hitting, and now they're back. They're back in the market, and that's a business that's owned by Linden Capital, a private equity group based out of Chicago. So, in terms of valuations, what are we likely to see? Well, from my perspective and what I'm seeing, we're not likely to see kind of the crazy valuations that we saw prior to COVID. I think that deal flow is going to be out there, and we're certainly seeing that, and deals are going to get closed. But we're not likely to see, the very lofty valuations that we saw in the past. As an example, in the behavioral health space, which was a very hot space prior to COVID and probably will continue to be post-COVID, we were seeing behavioral health companies that were, generating anywhere upwards of 5 to 10 million of EBITDA, commanding valuations in the, call it, mid to upper teens. It was not uncommon for an autism business, a growth-oriented autism services business, to trade for 16 to 20 times EBITDA. I think that those kinds of multiples are certainly not, we're not going to see them at least for the foreseeable future. However, I do think that we are going to see businesses trade for, what I would consider more normalized levels of EBITDA. Prior to the last few years of what I would consider, crazy EBITDA multiples being put out there by private equity groups, your kind of average medical group deal, physician practice management deal, generating, call it 10 to 15 million of EBITDA, was typically trading for anywhere from 7 to 9 times EBITDA. And I think that that's probably what's going to hold true in today's environment as well, as we move a little bit past COVID and more private equity groups start getting back into the market. The point that I'd like to make is that capital is still available for deals, and we're still in an environment where there are a record number of private equity groups that are out there that have access to funds that they've raised that they need to deploy. And they're out actively looking for deals. And so what we're going to see in a post-COVID environment is a flight to quality and a focus by private equity groups to looking for what they perceive as high-quality, growth-oriented healthcare businesses, and looking to put their capital to work. In addition to that, I think we're also going to see increased activity, obviously, amongst distressed deals. And those are going to trade, obviously, at very different multiples. But clearly, there's been some companies within various healthcare sectors that have been negatively affected. And I think that we're going to see some of those deals manifest themselves over the coming 6 to 12 months. So if we take a look at the transaction heat map, what are kind of some of the sectors in healthcare that we're seeing are going to be of more interest to buyers than not, or at least have more activity? Some of the areas that I would say, I mentioned healthcare IT, tech-enabled healthcare. I think anything having to do with telehealth or remote patient monitoring are areas that are very active right now. Behavioral health is remained held up fairly well because of the use of telemedicine within behavioral health. So things like psychiatric medical groups, I mentioned autism service providers, eating disorder businesses. I think those are still areas that are going to be quite attractive and are you're going to see increased activity over time. Homecare and hospice is another area that I think anything that can get the patient out of the hospital and into a home care setting, those are areas that private equity and other strategic buyers are looking to build up in. And then within the hospital and physician group subsectors, there are certain specialties that I think, at least from a private equity perspective, are top of mind right now. And some we've seen deals happen recently in the gastroenterology, in urology, and then we're also seeing deals in the orthopedic sector. But the bottom line is, I think if you have a high quality healthcare company that can demonstrate sustained earnings growth, and you've managed the COVID situation as well as possible, there's still dollars out there and there's still activity, in terms of the M&A markets. So I'll pause right there. That's kind of my overview on what's happening right now.
Thank you, Paul. That's quite a bit of material as we go through, and we're going to be diving into some of these sectors as we have our follow-up questions and agenda items on specific areas within healthcare where there's a particular focus right now. And that leads us to our first polling question. Emily?
All right, our first polling question today. What type of organization do you represent? And your options are A, physician organization, B, hospital or health system, C, investment capital such as private equity or venture capital, or D, other. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. And we'll give it just a few more seconds here. And let's go ahead and take a look at the results. Chris, back to you.
Thank you, Emily. So we have some physician organizations, a fair amount from the hospital health system side, and then quite a bit of other. So we'll work on trying to steer some of our comments in our discussion towards those categories. So we want to next go to our second agenda item, and that first one in current market trends had a number of slides, but the rest of these are really discussion prompts for the most part. And this is alignment between buyer and seller. And the question that often comes up when you're looking at healthcare organizations, particularly in the physician group space, is if they're looking at PE firm, potential PE buyers, VC buyers, health systems, or other buyers, how do you make those selections? Because the price points can be very different between those organizations. And I'd like to throw that out to Ryan and Paul. Any insight you have on the kinds of things that would lead an organization to see a better fit with one type of buyer as opposed to another? What are the key attributes that they're looking for?
Sure. I'll start and then pass it over to Paul here. I think from our experience, what we most commonly see in terms of PE, health system, strategic acquirer, is really the fit between seller and buyer in the go-forward model or the go-forward business, right? Most commonly, the kind of best situations or best fit is something where incentives are aligned between seller and buyer, and there's kind of one goal, one focus on the go-forward business, whether that be increasing kind of geographic presence, adding new ancillary business lines, or even kind of taking the administrative burden off of the service providers. I think overall, we're really seeing more of a kind of dynamic and kind of incentive-driven approach. Paul?
Yeah, I would say that there's obviously no right answer here, and every seller is different and every buyer is different. One of the things that we do when we're taking our clients through a process is to make sure that we're approaching a good cross-section of both strategic buyers as well as private equity buyers. Making sure that every buyer obviously is qualified and has the capital and has the wherewithal and interest in a potential transaction. And we get the process down to a point where it gives a chance for, if in the case of us having a sell-side client where we're representing the sellers, gives our client the chance, after they've received first rounds of bids, to understand and get to know the various top bidders. So let's call it, the top 5 or 10 bidders that are at the table. Maybe half of them are strategic, maybe half of them are private equity. And I think what's driving that is, what is the seller looking to get out of a transaction? Is he or she looking to sell 100% of the business? Is it a group of physicians, for example, that are tired of the administrative work and just want to hand it over to a large partner? Well, in that case, maybe a strategic buyer makes more sense to them than a private equity buyer. And then for those buyers that are looking at private equity buyers and want to stay on and want to continue growing the business and have sort of an executive and have a potential, call it a second bite at the apple, where they have a chance to, along with this new buyer, continue growing the business and ultimately exiting again at some point in the future. It's really about do they have the shared vision with the seller? Is it the right fit? And I think through the process of selling the business and reaching out to multiple different types of buyers, you ultimately find the right fit for your client. And that's what I found is the best way to move forward.
Thank you, Paul. It's an interesting question because the price points can be so different between those organizations. And so it's an interesting question as to how people go through that decision making, because frequently they're not selecting the highest price point, but they're looking for the best long-term fit.
And sometimes the best deal is not necessarily the one with the highest price as well.
That's right. And I don't know that that's always intuitive as organizations who are looking to sell are first going into that. But one example that I saw not too long ago was an organization that was approached by a PE firm to purchase their business. And the sticker price, the discussion was very high, but the long-term prospects and the discussion around how the business would continue post-transaction, what it would do, didn't ring as being credible and sustainable to the sellers. And so that was a major factor in declining that particular offer. So those are some of the factors that come up. And I know this is a near and dear topic to Ryan's heart, but when you look at a transaction, one of the real sticking points is the due diligence, and it's how do we prepare for a transaction today? We know, as Paul covered, that the pace of the transactions has slowed a little bit because of COVID. But what can organizations be doing now to prepare for a future transaction, and where do we often run into challenges?
Sure. Yeah, Chris, happy to share some insight. My experience, our team's experience in conducting due diligence, both from a buy and sell side perspective here. So if we advance ahead here to the next slide, I think the overarching theme in terms of preparing for due diligence is really going to be advanced preparation. It's definitely key to managing any due diligence process, financial, tax, operational, legal, is going to be organization and really getting yourself prepared, understanding kind of the process and what's going to come with that. So we really see advanced preparation consistently leads to more efficient, timely, and a less stressful process. The good thing is much of the work, I'm speaking from a financial due diligence perspective, much of the work to prepare for due diligence can be done prior to execution of an LOI. And this really allows you to minimize stress and kind of the anxiety that comes with time compression while under exclusivity. So a couple of, I guess, high-level questions here to start thinking about as you start entertaining the process of a transaction, due diligence. When was the last time you performed a deep dive into the historical performance of the business, got a good understanding of the KPIs, key drivers of revenue, expense, historical earnings? We find one outcome consistently out of our due diligence processes is that the business owners, stakeholders come away with a much more detailed understanding of their business, specifically what's driving performance and really the underlying processes. And a lot of the discussion and our work results in recommendations and positive changes to the processes. Another question here. So as you're thinking about your business, is this a straightforward, simple business and more complex? Most likely going to be somewhere in between. And something to remember is larger and more complex businesses, whether it be multiple locations, multiple service offerings, joint ventures, complex accounting billing systems, it doesn't always mean the due diligence process is going to be more intense. Really, again, advanced preparation mitigates the time and challenges associated with complexity. And kind of the third here, or go ahead, Chris.
I was just going to say, you also identify issues before you're in the time crunch of the LOI when you do it in advance. And there can be resolution to those issues, but it's very difficult to get fast resolution to some of those issues when you're already in the LOI. Sometimes there may be a tax issue that can be cleaned up, but it requires some correspondence with the IRS, and the IRS doesn't care that you have a transaction that's coming up. They're just very slow in dealing with certain things. And so doing this in advance is incredibly helpful.
Exactly. And kind of the third item here on this slide, which is, I guess from my perspective, kind of the biggest item is really what is the state of your financial records, right? So one, are your records in supporting schedules readily available in electronic format? Can you pull the last 24 months trial balances, income statements, balance sheets quickly? Can you provide them electronically? Do you have access to the billing data, the underlying encounter level data that you can share? Or do you need to reach out to third parties in order to get a lot of this information that ultimately you're going to be sharing? So thinking through how do I track down a lot of the information? Who do I need to open discussion with to do that? Kind of the biggest item within the historical financial records that we run into on every deal is, are we looking at GAAP, cash, or some type of maybe in-between basis of accounting here? And has that been applied consistently over the past couple of years? Overall, on almost all of the deals that we see, we're going to need to present some type of accrual basis financials. We really need to get a sense of what does revenue look like? What do costs look like? And so to do that, start thinking through, if I am on a cash basis, how can I convert these to GAAP? Do I have the relevant expertise to do that? Do I need to bring someone in to help me do that? And that really gives you a good sense of what's the impact of converting your financials from cash to GAAP. We've seen many times where cash revenues look great, deposits coming in the bank look great. And as we start to unwind that back to an accrual basis, a lot of these revenues in the current period may have been related to services performed 24 months, 36 months in the past. And so getting a very clear view on what is the revenue for the current period, it's very important in the due diligence process. In addition to that, as we're kind of feeling through the financials, getting an understanding of, are there significant one-time, non-recurring type events which are impacting revenue, impacting expense? How can we start to think about those in terms of putting a dollar amount next to them? And how does that impact your historical net income? How does that impact the historical EBITDA of the business? So again, kind of coming back to the key theme here is really starting to prepare that financial data, get access to the supporting analysis, the key drivers. Doing this in advance really results in a quicker and more efficient process once you engage due diligence, once you're under exclusivity in an LOI. So we really encourage you to reach out to us or work with your advisors to develop a plan early in order to get organized and start thinking about accumulating information and starting to provide that or preparing to provide that. I'm just going to switch here to the next slide. So a couple of other items that we wanted to highlight to kind of bring to everybody's attention here. The due diligence process can be intense. It is important to think about it in terms of, do I understand the full demands of the process, right? So demands on my time, providing requested information, and who's going to do all of this. So really identifying the key contact, the project manager, the responsible party who's going to be available to address questions, respond to information requests, coordinate meetings, coordinate phone calls, and thinking about it in the context of, does this person have availability to manage that process and perform their day job? So we've seen many times where we've been working with clients, we're kind of moving along in our process, and we start to get a little bit delayed just due to kind of the overwhelming responsibility on that one person. And we've had to get creative oftentimes to bring in other people or to try to manage the due diligence process while that key contact is also responsible for maybe processing payroll or financial reporting or the various responsibilities of their day-to-day position. Along those lines, I wanted to highlight a couple of items here around the kind of due diligence timeline. The requirements, from our perspective, usually the due diligence process spans 2 to 4 weeks typically. Obviously, this varies based on your timeline, the availability of information, and access to kind of the key personnel that we'll have questions for. Expect to block out at least a couple of days we used to do in person, but now kind of Zoom or video meetings to go through the due diligence questions, get a really good understanding of your business along with the processes. And throughout the 2 to 4 week timeline, also be prepared to participate in status update calls, question and answer calls. You really want to get a good sense of, what is my due diligence timeline and am I available during that period? You'd be surprised, but we run into this issue frequently in which we get engaged, we start our due diligence process, and key members of the management team have vacation schedule. And so we want to get started, everybody's on the same page, and all of a sudden that person is now gone for a week and a half. We can't get access to data, or we can't get access to ask questions in order to really push our process forward. One key item here that we kind of touched on is exclusivity, and making sure that you consider the exclusivity timeline when you're thinking about due diligence and when you're scheduling kind of the due diligence process, right? So you always want to leave yourself time between the expiration of your exclusivity and the kind of completion of due diligence in order to make informed decisions, digest the results of the due diligence, kind of strategize next steps, whether that be changes to purchase price or working capital issues, tax issues. You really want to give yourself a good amount of time to understand the issues, and are these deal breakers, or can we work through these, and do we need to have a conversation with the other side? We've encountered issues where we've been working with clients and the parties lose track of the exclusivity expiration date. Everybody keeps working, and one side turns around, enters into an LOI with another party, and so now that deal's over and it kind of comes out of the blue. So you really want to make sure that you've got a good handle on the timelines to kind of avoid surprises like that. And then the last item here on this slide is really thinking about information exchange. Seems like a fairly simple topic, but there can be challenges here. So what we really recommend is working together to coordinate how we're going to provide data to the due diligence teams, to third parties. Are we going to set up a virtual data room? We've seen clients who prefer to do everything via email. Somebody else can upload it to a data room. But really, consistency is key here. We want to make sure that you're not having to provide data multiple times, go back, request information, especially if it's coming from third parties, because that all can slow down the timeline. We've seen all kinds of methods of information exchange. Ones that I would not recommend are overnighting thumb drives to various third parties, due diligence teams. They will get lost in the mail, which causes issues for everyone, especially with the sensitive nature of that information. Another one we try to recommend against is paper information. So electronic is kind of best practice, and consistency in the means of providing information, whether it's data room, email, those are key. Let me skip ahead here. So this slide really just presents a kind of summary of the outcomes of the due diligence process, right? So we really want to get a good sense of what are the key issues, risk areas, what's driving the historical earnings or revenues of the business. Through the process and through our deliverable, one of the goals is to accelerate the understanding of the business. So from the sell side, we put together a due diligence report. We can share that with third parties, potential buyers, and it really minimizes the timeline between them getting introduced and getting a good understanding, an in-depth understanding of your business. And I think the next slide here is a question.
Okay, our next polling question: what topics are of most interest to you? And your options are A, transaction due diligence, B, transaction outlook for medical groups, C, how to work through COVID-specific transaction issues such as limited travel and dealing with federal programs such as PPP loans, HHS grants, etc., or D, what to do today to be better prepared for a future transaction. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We do have 2 more questions coming up. All right, let's go ahead and take a look at the results. Back to you.
Thank you, and it's helpful. We've had a lot of focus on due diligence and how to be better prepared for future transactions. So I'm glad that that's why people on the call in this webinar are here. Our next topic is really how transactions differ when you're looking at, let's say, a for-profit PE fund, for example, versus perhaps a tax-exempt health system as a buyer. I want to open that up. We discussed this a little bit earlier, but in terms of due diligence, in terms of the pricing, what are some of the differences that you see in how those transactions actually are carried out and come about? I'll open that up first to Paul, if you want to weigh in on that, and then Ryan.
Sure. So from my perspective as an investment banker, the real main difference to me as I'm representing a client is, when we're selling a business to a private equity group, or taking a client through a process where we have multiple private equity groups bidding for our client's business, it's really a market-based approach to determining valuation. We'll take the client through a formal process, as I mentioned earlier, where we'll contact numerous potential interested buyers and expect that each buyer will get back to us with their first round of bids by a specific date. Ultimately, we work the process down and to where we narrow it to one buyer, and we negotiate the terms of the deal, valuations, and all other key terms. So it's very much a market-based approach, an auction-based approach. When you're selling a business to call it a nonprofit healthcare system, for example, particularly if it's a physician group that's selling to a hospital system, then you can't really take an auction-based approach because the hospital itself cannot be perceived as paying any more or any less than fair market value. So they have to turn around and do a fair market value study, valuation, in order to determine the valuation of the business. There are also other elements that seem to be even more important when you're selling a business to a hospital system than necessarily the private equity group. For example, I did a cardiology deal a few years ago where we sold the business to one of the large health systems in town. And the key point for most of the docs was not necessarily the valuation of the practice, but was more related to negotiating the terms of their employment with the hospital system. So from that perspective, as an investment banker, that's kind of how I sort of see the differential. Ryan, I don't know if you have a different perspective on that.
Yeah, those are good points, Paul. I think from the due diligence process, there are some key differences when we think about the transaction and the buyer, whether that be private equity, a large health system, or other strategic buyer. We really see those kind of key focus areas. They are different kind of based on the nature of the buyer, right? So if this is going to be a kind of private equity investment, this is going to be a kind of an initial platform investment for the fund, then we may not see significant changes in the operational model of the business going forward. So there may be less time spent on integration or analyzing potential synergies of folding in kind of an administrative function or kind of other shared service that a strategic buyer already has in place. Similarly, with strategic buyers, we're going to see a little bit more detail or review of administrative operating costs, as well as payer contracts, to really understand if we're providing similar services, what's the spread between our contracts with payers. So I think those are kind of the key points there from the due diligence process.
Functionally, as we talk with a number of these organizations and they're looking at these options, when you're looking at a health system or a strategic buyer, oftentimes you're being moved onto their platforms and their policies, procedures, kind of bureaucracy. And so there's a lot of focus around what that would look like. Whereas if you have a PE fund coming in and acquiring the business, there's a higher likelihood that there'll be more autonomy and ability to continue doing things in a way, as long as it's functional and profitable, that you'll be able to continue doing things in a way that you're more accustomed to. So there can be some cultural issues that come out of that. We actually, before we get into the next agenda item, Emily, we have, I believe this is our final polling question.
So we have this polling question. We have one more coming up. This is our third question. What is the likelihood that your organization will engage in a transaction over the next 24 months? And your options are A, highly likely, B, somewhat likely, C, unlikely, or D, will not happen. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts to the right of the slide view. You'll also be sending the slides via email after the webcast. Just give everyone a couple more seconds here. And let's go ahead and see what everyone has to say. Back to you.
Thank you, Emily. And it looks like quite a few, over 57%, see this as at least somewhat likely in the next 2 years. So that's encouraging to see. So with our agenda, there's some special issues that come up when you look at closing a deal in the COVID era. And to set that up, typically in closing a transaction, there would be teams of people who are flying back and forth, getting to know the other side of the deal and spending significant time with each other, hammering out some of these details. And obviously there's some limitations both on travel, in-person meetings, social distancing, and all the rest of it. So I'd really love to hear both from Paul and Ryan as to what solutions you found. Do you see transactions closing where people never meet face-to-face in person? And if they do meet face-to-face in person, at what point in the deal negotiation is that taking place right now? Ryan, do you want to take that first?
Sure. So given kind of the current environment, we're seeing more of the due diligence process being conducted on a remote basis. So whether that's conference calls, video calls, almost all of the work can be done on a remote basis. We are starting to see, probably in the past 4 to 6 weeks, especially a pickup in deal-related travel. This is, at least in my experience, always between parties who are executed an LOI and are working towards close of a deal. And really just to get that interaction between management teams to go out and inspect the assets, the equipment. We're seeing a little bit of a pickup here most recently where possible. Paul?
Yeah, I would echo that. I think that buyers are doing whatever they can to, minimize having to go out and meet face-to-face given COVID environment. I would say that it's unlikely that a deal can close without some kind of in-person meeting. Private equity groups themselves have a fiduciary duty to their limited partners as managing of their money. And when they're sitting around a table, I think they just have to be able to answer the question, have you met this management team? And I think the same thing probably goes for strategic buyers, particularly if they're publicly traded companies. There's a fiduciary duty to that board. And I just don't see a deal closing without someone having, from a diligence perspective, having met the sellers of the business. Having said that, investment bankers are doing whatever they can to minimize and push out the need for person-to-person contact. Some of what they're doing is holding management presentations via web chat, and people are obviously now getting accustomed to doing web calls. And so a lot of these processes, you're seeing these management presentations, fielding a lot of the diligence calls via phone or web call and whatnot. But at some point later into the transaction, there's got to be an in-person meeting for a deal to actually close.
Thank you, Paul. I think that brings us to this next subject, which I know Ryan's going to focus on, which is how to handle some of the pandemic relief funds when you're structuring a transaction, because there's a lot of incentives out there. There's a lot of grants and forgivable loans through the CARES Act, for example, that require ongoing reporting, forgiveness reporting, other things after those funds are received. And if you have a transaction that's straddling some of those events, it can create some awkward situations that need to be thought through in the transaction structure. So with that, Paul, do you mind jumping into that topic?
You mean Ryan?
I can, yeah.
I did mean Ryan. Thank you for that correction.
Yeah, no problem. So this is kind of an evolving topic, obviously, as the PPP forgiveness periods are now approaching, and the rules around forgiveness continue to change. Based on our experience with deals we're working on currently, we're seeing a lot of focus on PPP loans or other funding, and how do we treat this for purposes of the purchase agreement. I think a couple of key areas are going to be, it's going to come down to One, is the loan forgivable? Has the business requested forgiveness? What steps have they taken in terms of submitting forms, and how did they originally record the transaction in the accounting records? And so getting a good understanding of kind of the basis of the PPP loan or other funding source really sets up kind of the next step is how do we treat this for purposes of a purchase agreement and purchase price? I think just based on our recent activity and experience, we're seeing kind of forgivable loans currently being held back in escrow as part of the purchase agreement. So really protecting the buyer from stepping in and for whatever reason, if that loan's not forgiven, that the debt is now on them. So that's what I'm seeing currently, but obviously things change and they're changing rapidly every day.
One other thing just to interject here for transactions that happened in the recent past is the CARES Act allowed some organizations to recoup taxes that they've paid in the past, and depending on the way the transaction had been structured, that is money that could either be returned to the original owners of that business, or it could be money that goes to the new owners of the business after the transaction, and both methods can be allowed. And so if the transaction agreement is silent on that topic, hopefully it's not, but if it is, it may require some negotiation between the two sides to make sure that there's not a lawsuit or some disagreements that happen down the road.
Certainly. A couple of other topics here I think that we wanted to cover just related to the COVID-19 impact on due diligence. We've covered kind of the timeline and travel, as well as the treatment of the PPP or other funding. A couple of other things that we're seeing are really kind of shifting focus areas of due diligence. We're seeing a little bit more focus on the current periods versus kind of historical EBITDA the last couple of years. We're seeing a lot of intense scrutiny on the current results, the current trailing 6-month period, trailing 12-month period, and really what's the impact of the economic shutdowns that occurred throughout the country in March and April, and how do we treat that for purposes of valuation? The other kind of key area in item that we're seeing in terms of purchase price is we're seeing an increase in the use of earnouts in purchase agreements to protect purchase price against continued declines in performance of businesses. So given the continuing impact of shutdowns and kind of modified schedules and how that is impacting businesses, we're seeing a lot more use of earnout structured 1, 2, 3 years into the future to really ensure that businesses can rebound back to their kind of normal levels of operations. And I think we can quickly go through the next slide here as we've covered these, but really, again, more focused towards the current period, looking at metrics like free cash flow versus only adjusted EBITDA, scrutiny of working capital, cash flow requirements at closing, and again, understanding the timeline and plan for reopening. How do we get back to a more normal business setting here? Okay, I think that brings us to the last poll question.
All right, thank you. Our final polling question: what is your role in your organization? And your options are A, executive leadership, B, finance, C, physician leadership, or D, other. And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. Give everyone just a couple more seconds here. All right, let's go ahead and take a look at the results. Back to you.
Thank you, Emily, and helpful to know who we have on the call. We have one final agenda item before we finish up, so the timing is perfect, and that really has to do with post-transaction feedback from sellers. And I'd love to get Paul's and Ryan's insights here. What I often see is that there's so much focus on finance and pricing and due diligence in the lead up to the transaction. Post-transaction cultural fit is king. There's almost no discussion afterwards as to whether the purchase price should have been 10% higher, 10% lower, wherever it should have been. It's really a focus on how well do the organizations align. And I've seen some very large transactions where the sellers are waiting out their non-compete period for 5 or 6 years, whatever long that is, and then going right back out and leaving the organization to start up a new business of their own, because the cultural fit is really challenging. In the physician world, where I see a big difference is when the buyer has physician leaders of its own that the seller's team can interface with. For that peer-to-peer discussion between physicians seems to make a very significant difference in terms of the seller feeling like it's a good cultural fit with the buyer. But I'd love to get your perspective, Paul, on that, what you're seeing in post-transaction feedback from sellers in the healthcare space.
Well, luckily, I've been very lucky in that. Obviously, a big part of making sure that the feedback post-transaction from sellers, if they're your client, is to make sure that the feedback is good and they're happy where they're at. Sometimes that's dependent on what the sellers wanted in the first place. If their if their need for a transaction was to ultimately exit the business, then that's a different story. But for the most part, if you go through a process and you've chosen the right buyer, that's why a kind of an auction process is much better than just doing a one-off transaction. Then, in theory, by the time you've finished the transaction and you've closed with the final buyer, it should be that you've had a meeting of the minds and there's a shared vision of how the business is going to evolve going forward. There are obviously times where that shared vision doesn't happen and it doesn't lead to the seller sticking around for very long after any obligations that seller has are over. But for the most part, my experience has been, most of the deals that I've worked on, they've had pretty good experiences with the sellers staying on and enjoying the relationship that they have with the partner going forward.
Wonderful. Ryan, do you have any thoughts on that before we conclude?
I think just really to echo what Paul said, it's important up front to really get a good feeling of the interested parties and just make sure that the incentives are aligned, not only just in choosing the highest purchase price, but making sure that for 1 year, 5 years, kind of the future vision of the business you're aligned on, and it's something that you're excited about. So I'll turn it back to you, Chris.
Thank you. Sorry, I was muted and I was trying to find the button to unmute myself. Thank you for your insights, Paul and Ryan. It's been wonderful to present with you. That's the end of our prepared remarks. I'm going to turn the time over to Emily at this point.
All right, thank you. And thank you, Chris, Paul, and Ryan, for a great presentation today. We are a couple minutes over, so we don't have time for questions. However, if you think of something, you may reach out to either of our presenters in the speaker bio widget. You can click on their email address there. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.